As I'm filming this video, my portfolio is down at about 6%. And I'm not gonna lie, it's not funny. Yes, it's not funny. But as someone that started investing not too long ago, though, but for some times now, because I took my time to do research before I started investing, because I don't like going into something I don't have knowledge about. So by the time I was convinced enough, then I started investing. So I am not like I'm not moved, though it's not funny, but it's normal in equity market. But you see this period now, it should be seen as an opportunity. This is not the first time something like this is happening. Although the reason for this crash now, which is a tariff and all that, I don't want to go into it because bear market happens every 3 to 5 years, and something, one thing or the other brings about it, right? And but the thing is that anytime there's a bear market, by the way, by bear market I means market crash, right? Anytime there's bear market, it's always like bounce back. And you know what? It doesn't just bounce back, it bounces back aggressively. So this period presents an opportunity to buy cheaper prices. And I know as a beginner, this period comes with lots of fear, and it's absolutely normal. Nobody will watch their money go down like that and feel happy. I myself, like I said earlier, it is not funny. But the truth is that it is only when you decide to sell those stocks, maybe out of fear, that you have lost money. If you leave it there, if you leave the stock alone, let it be, okay? And it bounces back, which it will eventually do based on the history of stock markets. You have not lost any money. And this is why I prefer long-term investments. So what I'm doing now is called dollar cost averaging, which is one of the four principles of stock market investing. The other three principles are asset allocation, index funds, and rebalancing. But for today, I'm not going to go into detailed information or explanation on those three. I'll be focusing on dollar cost averaging. But my next video will cover those other three principles of investing. So please, if you haven't subscribed to my channel, please hit that subscribe button so you don't miss out when the video drops. So what is this dollar cost averaging I said I am doing now? Dollar cost averaging is how you make the volatility of the market work for you. And this is how it works. Let's say you decide to be investing $1,000 into your funds every year, and you are consistently investing in these funds yearly with this $1,000, even when there's a market crash. What will happen is that during this market crash, you're going to get more funds because at that time the price is cheaper. Now, because in the history of stock market there has never been a crash that doesn't recover, and it recovers aggressively. So what happens is that when it recovers, remember you have more funds now, right? Because of the market crash. So this is how you make your money.
Now, let me even explain further. Let's say before the crash, the price for the fund was $25. And during the crash, it went down to $10. Before the crash, your $1,000 got you 40 stocks. And during the crash, your $1,000 got you 100 stocks. So when the market recovers, like I said, it will always recover. And let's say from $25 it's now $40, for example. So this means that before the crash, the 40 stock you got is going to make you $1,600. And during the crash, that 100 stock you acquire is going to make you $4,000. Did you see the difference? This is insane. When I learned this, I was like, wow. And this is how you make your money. The key there is being consistent, because 100% of the time, the stock market recovers. And it doesn't just recover, it recovers aggressively. Now, when people, including myself, tries to outsmart the market, you're reading all those books and you are aware that a market crash is on the way, and you decide I'm going to pull out all the money in my investment and I'm going to put them, keep them in cash, so that whenever the crash is over, I'll put out the money and then put back into my investments. It sounds interesting. It sounds, in fact, it sounds intelligent, right? But this is the worst thing you could do. Now, here is the research. Over the recent 20 years period, the S&P 500 returned an average of 8.2% in a year. However, if you miss the top 10 trading days during those 20 years, your returns dwindle to 4.5%. And again, if you miss the top 20 trading days in those 20 years, your returns move down to 2.1%. You see, this is to show you that leaving your money as cash during those crash period is not advisable. So now I would like to share a list of my favorite ETFs that I like to invest in, and it will be great for you, especially if you are a beginner. The first one is S&P 500, which tracks the 500 largest companies in America. This fund has a track record of between 8 to 15% returns every year. And if you're in Canada, you can consider ZSP, VFV, VOO. They all essentially do the same thing. They are just different providers. So when you buy these stocks, you own a certain percentage of the stock of these companies. Example like Amazon, Microsoft, Apple, Costco, name them, Nvidia, yeah, and the rest. The next one is dividend ETF like the ZEQT, yeah, from the bank BMO, and also VDY, SIC, yes. So these are some of the ETFs I love to invest in. So if you ask me, now is a good time to start investing if you haven't started. And also, if you've started investing, please continue investing and try and be consistent. Just like Warren Buffett said, be fearful when others are greedy and be greedy when others are fearful. We keep investing. If you find this video helpful, please help me and hit that like button. I will really appreciate it because it's going to help the algorithm to recommend my channels to others. Thank you all so much for watching my video, and I will see you in my next one. Keep investing.